My favorite stocks near their 52-week low. Are these the best stocks to buy now? A lot of people are talking about another crash or recession coming up very soon, if not already. And of course, these are the times that big money is made, but please be careful and always do your own research. In this video, I'm going to check 4 stocks that are almost at their 52-week lows. I'm not going into detail that much, but it's more about showing the main statistics. Always dive in deeper yourself. I'm very excited to see what you guys think about these stocks, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, first stock on this list is HomeDepot. HomeDepot is the world's largest home improvement specialty retailer in the United States, Canada and Mexico. Its stores offers numerous building materials, home improvement products, lawn and garden products and decor products. HomeDepot stock is down 31% year to date, while the S&P 500 is down only 21%. HomeDepot has a 52-week high of $420 and a 52-week low of $267. Right now they are at $279 as of recording this video. HomeDepot is a $287 billion market cap company with a PE ratio of 17, which could indicate that this stock is undervalued right now. They have a 12 trailing month revenue of $152 billion, and in this graph we see that the revenue is going up quite nice and steady, especially during and after the lockdown periods. Right now, profit margin is at 10.8%, which is above the minimum of 10%, so this looks all good to me. HomeDepot has a return on assets of 16.8%, which is very nice and above the minimum of 10%. Return on equity doesn't look that good, but return on invested capital is very good at 25%, and the 5-year average is also very high. It's very important that companies like HomeDepot have an increasing free cash flow, since this is used to pay down debt, buy back shares, pay dividends and do acquisitions. In this graph we see that free cash flow is growing very nice and consistent. The big increase we see is related to the lockdown periods, but the overall trend line looks very good. Another thing that's very important are the shares outstanding. In this graph we see that HomeDepot bought back a lot of shares. In the past 5 years it's around 40% buyback, which is very high and adds a lot of value to the investor. This makes it more easier to maintain the dividends and of course increase them. And this is also one of the reasons why people love HomeDepot. They have a 2.7% dividend yield, which is pretty high for a company this big. The annual payout is at $7.6 or $1.9 a quarter. Payout ratio is at 45%, meaning they have 55% left in cash to pay down debt, buy back shares and do acquisitions. The 5-year growth rate is at 17%, which is also very high, and they grew the dividends for 9 years in a row. To be honest, this looks like a great dividend growth stock. As I told earlier, HomeDepot is down roughly 31% year to date. When I use the Everything Money software to come up with 3 price targets based on my assumptions, low, mid and high, we see that HomeDepot might be a buy. Right now they are at $279, and based on the mid assumption we have a price target of $290, and based on my high assumption we have a price target of $360 to $380. To be honest, I think they are within the mid-range, which is around the $290 to $305 price target. But if you believe the high assumptions, it's a buy all day. My conclusion on the stock is that I think it's a great dividend growth stock. They pay a great dividend, buy back a lot of shares and have an increasing revenue and free cash flow. HomeDepot is one of the biggest holdings in my portfolio, and with reason. So I'm definitely buying this stock at these prices. Next stock on this list is PayPal. PayPal provides electronic payment solutions to merchants and consumers with a focus on online transactions. PayPal stock is down 62% year to date, which is quite a lot compared to the S&P 500 being down only 21%. PayPal has a 52-week high of $320 and a 52-week low of $68, which is quite a difference to say the least. So, is PayPal stock a buy at current prices? Let's find out. PayPal is a $85 billion market cap company with a PE ratio of 23.7, which could indicate that this stock near its fair valuation based on the PE ratio. But since this is considered as a growth stock, it might be undervalued, so let's find out. PayPal has a $25 billion 12 trailing month revenue, and in this graph we see that revenue is going up quite nice and steady, so this looks very good to me. Profit margin is at almost 14%, so this looks also very good to me. But keep an eye on the 5-year average, since their current profit margin is lower than the 5-year average. Return on assets seems a bit low at 5.5%, since this is below the 10% minimum. Return on equity looks very good at almost 70%, and return on invested capital looks also very good at 15%, especially since this is above the 5-year average. Free cash flow is increasing, but it's not really that consistent. But as long as it's growing in the long run, I think it's fine. And it's very important that PayPal has an increasing free cash flow, since this is used to buy back shares, pay down debt and do acquisitions. And since PayPal doesn't pay any dividends, all the free cash flow can be used for the things I just mentioned. PayPal is also buying back shares, but it's not really consistent, so keep an eye on this number. In the past 5 years they bought back roughly 3%, so that's quite okay for a company like PayPal. I'm using the software of Everything Money to come up with 3 price targets, a low, mid and high assumption. Based on these assumptions, PayPal is a buy to me. So if you believe these numbers, please dive in deeper and do some more research on the stock. My conclusion on the stock is that PayPal is hammered down a lot this year, around 60% down year to date. At current prices you can't ignore PayPal, but you have to do some more research on the stock. How are the users and merchants growing? What is the outlook, and are they going to increase the share buybacks? For now I'm waiting just a little bit longer and do some more research, but I'm keeping a close watch on the stock, since I truly believe in the business and the price targets tell me that they are a buy based on the assumptions. Third company on this list is Nike. Nike is the largest athletic footwear and apparel brand in the world. It designs, develops and markets athletic apparel, footwear, equipment and accessories. Nike stock is down 37% year to date, which is quite a lot compared to the S&P 500 being down only 21% year to date. Nike has a 52-week high of $179 and a 52-week low of $100. Right now Nike is around $103, so almost at its 52 weeks low. Does this mean that Nike is a buy right now? Let's find out. Nike is a 163 billion market cap company with a PE ratio of 26, which means you pay a premium for the stock, even after the 37% drop this year. Revenue is at 46 billion in the 12 trailing months, and in this graph we see that Nike has a steady and consistent revenue growth over the past years. The decline is during the lockdown period, so that doesn't worry me at all. Profit margin is at 30% and significantly higher than the 5-year average of 9.9%. And this is because Nike is cutting the middleman, meaning they are selling direct to consumer and margins are increasing. Return on assets is above the minimum, so this looks all good to me. Return on equity is at 43%, also very nice, and return on invested capital is also good at 18% and above the 5-year average. Free cash flow is growing quite nice but not always steady. The big decline is because of the lockdown period, so nothing to worry about. Since 2016 the free cash flow is growing quite steady though, so this looks all good to me. Nike is buying back a decent amount of shares. In the past 5 years, Nike bought back roughly 5%. The increase in shares outstanding is again related to the lockdown periods, and don't worry me at all. This looks pretty good to me. Nike has a 1.2% dividend yield, which is not the highest, but to be honest, when the stock falls down in stock price, the dividend yield is increasing, so that's quite interesting. And on top of that, they are increasing the dividends at a decent amount. Growth rate is sitting at 11% and they increased the dividends for 20 years in a row. So to me, this looks very good. Again, I'm using the Everything Money software to come up with 3 price targets, a low, mid and high based on my assumptions. If you believe these high numbers, Nike stock is a buy at current prices. If you believe the other assumptions, this stock is a bit overvalued. My final conclusion on this stock is that I'm waiting for more share buybacks and margins that are increasing. When this happens, free cash flow will increase as well and this stock might enter the buying area. So for now I'm waiting on the stock to come down just a little bit. But I really like the other parts of the stock, so I'm definitely buying this one when the time is right. Last stock on this list is Texas Instruments. Texas Instruments generates over 95% of its revenue from semiconductors and the remainder from its well-known calculators. Texas Instruments is the world's largest maker of analog chips, which are used to process real-world signals such as sound and power. Texas Instruments also has a leading market share position in processors and microcontrollers used in a wide variety of electronic applications. Texas Instruments, or ticker symbol TXN, is down 23% year to date, which isn't a lot compared to the S&P 500. But with a 52-week high of $202 a share and a 52-week low of $144, it's entering a very interesting area, since this stock is around $146 right now. So let's find out if TXN stock is a buy. Texas Instruments is a 135 billion market cap company with a PE ratio of 16, which could indicate that they are undervalued. The 12 trading month revenue is at almost 19 billion, and in this graph we see that revenue is going up and down quite a lot. But in the long run they are up, and this is also because of the demand for chips. Profit margin is at 43%, which is very high and also typical for this industry. The current profit margin is also significantly higher than the 5-year average, which is also very nice. Return on asset is very high at 25%, and so is the return on equity at almost 65%. The return on invested capital is also very high at almost 28%, so this looks very good to me. Free cash flow is going up in the long run, but in 2019 and in 2020 there was a small decline. But after the lockdown period it's going up again, so keep an eye on this number, since it's important to have an increase in free cash flow, since this is used to pay down debt, buy back shares, do acquisitions, and of course pay dividends. In the past 5 years, TXN bought back roughly 7.5% of the shares outstanding, which is quite nice and adds a lot of value to the investor. Next to that, it's more easier to maintain the dividends and of course increase them. And to be honest, their dividend scorecard is quite impressive. Dividend yield is at 3.1%, which is quite high. Payout ratio is also very nice at 48%, meaning they have 52% left in cash to pay down debt, buy back shares and do acquisitions. The 5-year growth rate is at almost 19%, which is also very high, and they grew the dividends for 16 years in a row. Overall, this dashboard looks really good to me from a dividends perspective. I'm using the Everything Money software to come up with 3 price targets based on my low, mid and high assumptions. And here comes the deal. Based on my assumptions, Texas Instruments is only a buy at the high assumption. And right now it's valued slightly above the mid assumption. So this stock needs to fall down just a little bit. But if we change the revenue growth by 1% point in the 3 assumptions, we see that TXN stock is a buy. So if you believe that Texas Instruments can grow the revenue at mid-single digits, this stock is a buy right now. My final conclusion on this stock is that I want to see a bit more steadier revenue growth before I'm going to buy this stock. So I'm doing a bit more research on why the revenue isn't steady right now. And I'm adding them to my watch list, since this is a great stock from dividends perspective. And if I can find out why revenue isn't consistent and I believe the higher revenue growth numbers, it's also buy from a value point investing. So this was the full video on 4 stocks that are at their 52 weeks low, or at least almost. I'm definitely paying close attention to these stocks, since they are all great companies, and if you believe the numbers, then they might be a buy. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.